Live.
Hi, everyone. We're here today with Jenn McLean from Mortgage Pal. She's going to go over some information for first-time home buyers. Jenn, you want to take it away?
Yes, thank you so much. All right, this is my, I think, fifth and final installment of our webinar series. So thank you again so much for having me. It's been so much fun. So today I'm going to go over some programs for first-time home buyers, answer some FAQs. There have been a lot of changes to government programs in the past year, and it's important to understand what is available to those who are considering jumping into the real estate market for the first time. Okay, so making that first purchase can be daunting. And if you're gearing up to enter the market, then you probably have a lot of questions. So to help you avoid at least some Googling, here are a few straightforward answers to some of the most common questions that I have found first-time homebuyers often ask. So the first one is, do I have to be debt-free to qualify? So while it is ideal to have low debt levels, having some debt doesn't automatically disqualify you. Lenders are going to look at your debt to income ratio to determine if you can responsibly manage your mortgage payments along with your existing debt. So keeping that ratio low can improve your chances of approval, but higher ratios aren't always a deal breaker. We just have to look at your debt level specifically and see how it impacts your borrowing capacity. Do I have to put 20% down? Not necessarily. While a 20% down payment does help you avoid paying for mortgage default insurance, you can put as little as 5% down on homes $500,000 or under. Just remember, a smaller down payment means larger monthly payments and more interest over time. The next question, should I go with a fixed or variable rate? So fixed rates offer stability, as your payments won't change during the term. This makes budgeting easier, but it can come at a premium. Variable rates can be lower initially, but fluctuate with market conditions. So weigh your comfort with risk and your financial flexibility before deciding. And then how do I set a realistic budget? So start by assessing your monthly income and expenses to figure out what you can comfortably afford without stretching yourself too thin. So a lot of people look at what they pay in rent as kind of the gauge as how much they want to pay for their mortgage. That's a good starting point, but it doesn't take into consideration all of the other costs associated with being a homeowner. Costs like property taxes, utilities, and maintenance of your home. So make sure those are included in your budget as well. A mortgage affordability calculator can provide a helpful starting point, but it's always good to look at what all of those costs are going to be. Tanya, do you have a question?
Yeah. So in terms of maintenance and upkeep, I've heard of really, really general, you should be saving 1 to 2% of the value of your home every year just to tuck it aside and make sure that you have a contingency. And now, from your perspective, how would you feel that would vary between property types, or do you have a different number that you generally tell folks?
Yeah, that is a really solid question. And you're right. It depends a lot on the property, depends on its age. What kind of, is it a single detached house? Is it a condo? Because all of those things are going to play into it as well. If you have a single detached house, those costs can be much higher, like if you have to replace the roof, those types of things. But yeah, the 1 to 2% rule can be a good kind of gauge, but I think really it depends. So when you're buying your home, you should really get a solid home inspection so you can understand where things are at as you're going into it. If you know that the furnace is 15 years old, or the windows have never been replaced and the property's 30 years old, those kind of things are going to be really helpful in terms of setting up future costs that are going to be coming down the pipeline. You're probably going to have to spend $15,000 to $20,000 on new windows. Eventually you're going to have to replace that furnace for maybe $10,000. Right away if you're going to have to replace those appliances. So factor those kinds of costs into it as a I'm going to need this much money in the next 5 years. I'm going to need this much money right away.
Mhm.
And that would probably be a good way to kind of start to build that fund. But then also taking into consideration, things happen all the time. You might need a plumber in, you might need an electrician. You know, you might need some sort of help without all of those larger capital projects. So yeah, having a bit of a budget is going to make a big difference so that you're not pulling from credit when the time comes that you're going to need, when the house tells you what it needs. But yeah, 1 to 2% of the property value isn't necessarily going to be reasonable for everybody. It's not always going to be, sometimes it's going to be more, sometimes it's going to be less. So I always want to take that home inspection and do a little bit of a projection on how much money am I going to be spending in the next 5 to 10 years on this house, and go from there.
Awesome.
And then lastly, what does my credit score need to be? So while there's no universal score across lenders, a credit score of 660 or higher often unlocks the best rates. So the higher your score, the lower your perceived risk, which means more favorable terms. But remember that lenders also consider your entire financial situation, not just your score. They're going to be looking at, do you have late payments? Do you have a lot of credit available to you? Have you had a lot of credit inquiries in the past? Have you done a lot of balance transfers? Those types of things. So they're going to look at the whole credit profile, not just what your score is. So if you do have a score of 660, but it's just a matter of the fact that you don't use a lot of credit, yeah, that might not be a very high score, but you might still be a low risk because you're just not using a lot of credit. So it really just depends. All right. So a question I get from a lot of people is, am I a first-time home buyer if I've owned a house in the past? And the answer is often yeah. So the Canadian government, they've announced some really exciting changes to help make homeownership dreams more attainable, while trying to not stir too much excitement and make demand higher, because that's a problem that we've had. Not enough supply, too much demand, that pushes up housing prices, thus making it even more difficult for people to get into the housing market. So they've enacted some changes that are really specific to just first-time home buyers. So longer amortization periods, increased RRSP withdrawal limits. I'll get into all of these in a minute. They could be a game changer for someone who's on their home buying journey. So do you qualify as a first-time home buyer? You do if you've never purchased a home, of course, or in the last 4 years, that 4 calendar years, you haven't occupied a home as a principal residence that either you or your spouse or common law partner owns, or you've recently experienced a breakdown of marriage or common law partnership. So those are kind of the 3 factors that are going to determine if you're a first-time home buyer. Tanya?
If you're the last bullet,
Yeah.
do you have to wait the 4 years, or is there a specific time stipulation there?
No, it's right away.
Right away.
Yeah. So if you've gone through a separation, if you have a separation agreement that shows that you are officially separated, or a divorce order, whichever one, then it resets the clock from that moment on. You're considered a first-time home buyer again.
Nice.
I know that. Yeah. They just put that in place, I think a couple of years ago, but yeah, really helpful, right? Because a lot of times when you separate, when there's a marriage breakdown, your intention is to buy a new home. And so you can take advantage of those first-time home buyer opportunities again.
Excellent.
Okay, so increasing, and this is one of the things that they've changed in the last year. So increasing insured mortgages from 1 million purchase price up to 1.5 million. This isn't necessarily going to be a huge help for everybody, but it's going to allow buyers to access insured mortgage products in more expensive urban centers. And I'm looking at Okotoks as a great example, or all of those like acreages where people wanted to start living after the pandemic hit. Those types of homes, those prices skyrocketed and quickly went above the $1 million mark. So the key benefit here is less upfront capital required to make that purchase. So before, if you wanted to buy a $1 million home, you had to have a minimum down payment of $200,000. Now you can put as little as $75,000 down. And if you go up to just under 1.5 million, you would need a minimum down payment of 125,000. Whereas before it would have required 300K. Keeping in mind, this is going to mean higher payments, obviously, because you're going in with less capital up front. All right, then starting August 1st last year, first-time buyers can now opt for a 30-year amortization on insured mortgages, which is super great, or for newly built homes. And this doesn't only apply to first-time buyers. Anyone who's buying a newly built home can also get an insured mortgage with 30-year amortization. Now, this longer repayment period is aimed at making monthly mortgage payments more affordable. One thing to keep in mind is the mortgage default insurance premium is going to be 0.2% higher for a 30-year amortized mortgage. So it will increase the total monthly mortgage amount slightly. But I will tell you, I have helped a ton of first-time home buyers in 2025, and almost all of them, if they've been insured, like with less than 20% down, have taken that 30-year amortization. It makes a big difference in their wallets at the end of the month, and reduces how much they have to pay for the mortgage every month. And if they want to take advantage of prepayment privileges, if their budget allows, they can do so then. But it's been a very, very popular change for first-time buyers. Then we've got the home buyers plan, which is the RRSP withdrawal loan. Basically, you're borrowing your RSP to use toward your down payment. So this is nearly doubled. It was $35,000, and now it's gone up to $60,000 as of April. So those who make withdrawals between January 1st, 2022 and December 31st, 2025, so that up to the end of this year, have up to 5 years to begin repayment instead of 2. So before you had a grace period of 2 years, now you have a grace period of 5. So this aims to make down payments more attainable for younger Canadians as well. And I have definitely seen an increased use of this home buyers plan as people are utilizing more of their RRSPs to buy their first homes. So changes intended to improve affordability and encourage new housing supply. So there's debate around the potential impact on home prices and affordability, but there's a lot of factors that increase home prices. And so far, none of these programs have really changed, had a negative effect on the housing prices. Okay. So consistently rising home prices and an uncertain economy can make the dream of home ownership seem out of reach. But I am really excited about this product. It's the First Home Savings Account, the FHSA. It can be a secret weapon to obtaining that first home faster. So what is the FHSA? It's a tax advantage savings tool designed to help first-time home buyers. So you can have an annual contribution of up to $8,000 and a lifetime limit of $40,000. The FHSA offers a tax-deductible contributions, just like the RRSP does, and tax-free withdrawals for home purchase, just like, say, a TFSA. So I always say, kickstart the FHSA as early as possible to maximize that compound interest. Consistent early contributions can significantly increase your total savings, making your dream home achievable sooner. So some people are like, well, I'm going to buy, early next year. Why would I bother taking out an FHSA? I think it's still valuable to do so, even if it's just $8,000 because of those tax incentives. If you're able to apply $8,000 take it from your savings, for example, apply it to your FHSA, you're going to see that return come back when you file your taxes next year. Yeah, Kelly.
So if someone is, say, going through that separation or divorce, are they still able to do this FHSA?
Yes. So you would start again at year 1 as soon as you've gone through that separation.
Okay. Interesting. Cool.
Yeah. And then again, if you sold a house and you're not living in a house you own, you have to wait 4 full calendar years to begin the FHSA.
Okay.
But yeah, as a newly separated person, you could start that FHSA right away.
Okay. Interesting. Cool.
Yeah. And yeah, some people complained, $8,000, that's not a lot of money. Well, to a first-time home buyer, it is. It could be a lot of money. And
a good chunk of money you can put away that's tax-free.
For sure. I look at people like my daughter's age, she's 21, starting an FHSA at 20 and slowly contributing that up to $40,000 by the time you're, ready to buy a home. You've got $40,000 that you contributed plus whatever compound interest has occurred. Plus, if you're taking advantage of the RSPs, it's not a bad strategy at all.
Well, yeah.
It's been a super popular.
And we should just talk a little bit about how, starting small can also be an advantage. And a lot of people don't think about it that way. They're like, oh, I'll never own a home, not recognizing just how attainable it is for them to, purchase a 1 or a 2 bedroom apartment.
Yes.
With
very little down.
Right? Like $10,000.
Yeah.
And that's going to be a down payment on a the vast majority of apartments in the city of Calgary at this point in time.
Absolutely.
Anyways,
Absolutely.
there you can find a lot for 200 grand
somewhere, really.
Yes.
So.
I couldn't agree more. And the best time to do it is when you're young, you're out in the world, you're paying rent anyway. If you're able to get into a little condo of your own, that's where you start. And everyone I know who's my age, if they started in their 20s owning a condo, I saw them upgrade into bigger homes a lot earlier than the rest of us did.
Mm-hmm.
It plans to start early and start small because at least it gets you into the market, right? And you're right, buying a little condo today in Calgary is a great time. It's a great time to buy. It's a buyer's market for those condos. And in 5 years, you are probably ready to upgrade. You can buy something more expensive, something bigger, but it gets you started in there. And it really doesn't take a lot of money at first.
Yeah. And as long as you don't have to sell, as long as you can hold the property for the right time, it's pretty hard to lose.
I have a whole presentation I did once just for the Gen Zs and how to leverage your first condo purchase to buy more in the future. It's like this planned out strategy where you end up with 3 or 4 properties and you're in a house of your own, maybe the dream house, and you've got these properties that you used as kind of a jumping point that are now part of your investment portfolio. They're going to help you build financial wealth in the future. And it's because you were willing to live in a 500 square foot condo when you first started, and you used it as a tool to help you get up in the market and build that wealth. So yeah, I love that kind of stuff.
Sounds like we need to schedule another
I'm a strategy junkie, as you might
another webinar
be able to tell. Yeah, exactly. Yeah, so combine your tools. You can combine your FHSA with your RRSP home buyers plan for great financial power. Use both accounts strategically for the most substantial down payment possible.
Mm-hmm.
Okay, purchase plus improvement. Now, this isn't just for first-time home buyers, but I love this for first-time home buyers. So if you've been out shopping for a first home or maybe even your dream home, it's possible that none of the properties are going to be hitting the mark. Maybe one is perfect, but the kitchen is drab, or maybe another one will need a new roof, but the interior is in peak condition. Or maybe the home, if it had a suite, it would be everything you've ever dreamed of. You got a mortgage helper in the basement suddenly. So the cost of doing these types of renovations is going to be steep for anyone, but especially a first-time home buyer. Finding the cash to do it after shelling out all of your savings for the down payment can be tough, and it's simply unrealistic. So this is where we can take some of the projected value of a home if you were to do those renovations and help you get the money when you close on your purchase. So you can add the money you need to your new mortgage, and it allow you to make those necessary upgrades. So it's not going to change your monthly payment by very much, and you don't have to spend years saving up to do that renovation. So here's how the numbers work. So let's say your home is priced to sell at the house that you're going to buy is priced to sell at $650,000. You've got your down payment minimum $40K, which is what you need. And the cost to renovate is also going to be $40,000. So you have two options here. You can buy the house and save $40,000 after you buy over time to do the renovation, or you can use the Purchase Plus Improvement Program to build the $40,000 renovation into the cost of the mortgage. So how do these options compare? Okay, so option one is you buy the house and then just slowly save up that $40,000. While you have to come up with that additional 40 for the down, sorry, I'm getting lost here. So with the Purchase Plus Improvement, yes, you have to come up with a slightly higher down payment. It goes from $40,000 to $44,000. But your monthly payment difference is only $217 a month. And with that, as you can see, you get a much higher mortgage amount because you're factoring that $40,000 into the renovation, but you're also increasing the value of your home by probably much more than $40,000. And you get that new kitchen or new basement suite or whatever it was that you wanted to do. And alternatively, how long is it going to take you to save $40,000 to pay for the renovation in full? I mean, again, how long did it take you to save all that money for your down payment? It's going to take you just as long to save for that.
You're certainly not getting very far on $217 a month.
Exactly.
If you were like, I mean, realistically, like, you know, if your mortgage costs you $217 a month and now you have a beautiful home, if you were like, oh, well, I can afford that 217, and instead of tucking that 217 into savings, you get that place beautiful, like you like it right off the hop. And like, I mean, at $217 a month to save $40,000 to do those renovations would take an incredible amount of time.
Yeah, exactly. Yeah. If you can afford a mortgage of, you know, $3,686 a month, you can probably afford a mortgage payment of $3,903 a month. It's not a huge difference, and it's going to be, it's basically giving you the house that you really want right out of the gate. Because I know so many people, they're like, oh, I love this house, I'm going to do this and this and this. And then they never end up doing it because, yeah, it costs a lot of money to do that stuff. So that's why I love the Purchase Plus Improvement program. It's a great way to do that right out of the gate. Okay, so if you're buying a newly built home and you've got less than 20% down for your down payment, that means you're getting an insured mortgage again. You could be eligible for a 25% refund on the default insurance premium if that home meets current energy efficient certifications. And pretty much all new built homes these days are going to qualify. So let's just say on an $800,000 purchase price with a minimum down payment, that could mean $7,450 in your back pocket. So I'm not sure exactly what the regulations in Alberta are, but it would make pretty much all new homes eligible for the rebate. And every new build will have a 5-year window for insured purchasers to use the energy efficient certification for their refund. So if someone's buying a house or a unit that was built in 2022, for example, that has this certification, they are also eligible for the refund if they buy that today. So it's not just for first-time home buyers either. It's eligible to anyone who's buying a home that was built within the last 5 years under that, and that has that certification. And then it's also, of course, insured. So you're putting less than 20% down, or you are paying that mortgage default insurance. And then how do you apply for the refund? You simply apply to the insurer who has your insured mortgage. So that's going to be either CMHC, Sagen, or Canada Guarantee, and they will issue the rebate after closing. Okay, so I'm just going to wrap up here and talk a little bit about the market and where we're at currently. I think whenever I listen to an economist or anybody talking about the economy or the market right now, the word that consistently gets used is uncertain. Uncertainty is like the favorite word of 2025. So despite 9 Bank of Canada rate cuts, bringing mortgage rates below 4% since last summer, like the previous summer, home sales have remained surprisingly sluggish across most major Canadian markets. This contradiction reveals a really important truth. Affordability isn't driving the market, but confidence is. Because while lower rates mathematically improve buying power, this always looming threat of the tariffs and the trade war, that's creating genuine concerns about job security, and the cost of living increases. So for many potential buyers, even attractive mortgage rates can't overcome the anxiety of economic uncertainty. And the result is a market that defies simple predictions. So some regions will feel these opposing forces differently than others, creating both challenges and opportunities depending on your local conditions and your personal circumstances. Are you focused on today's improved affordability, or are you waiting to see how the trade situation unfolds? This market is the market's direction may ultimately depend on which force proves stronger. So which force will prove stronger? Let's break it down. The Bank of Canada has slashed rates by 2.75% since June 2024. Today, the most 5-year variable and fixed rates sit at or below 4%. Historically attractive levels that should boost buying power significantly. For a $600,000 mortgage, for example, today's rates translate to roughly $500 less per month than even a year ago. Meaningful savings for any household budget. But the reality is, despite lower rates, market activity has been surprisingly slow and sluggish. Toronto is a great example. Their sales are down almost 28% year over year since as of the spring. Vancouver transactions down 30% below the 10-year average. And even Alberta, which had a really strong housing market, is now starting to see those double-digit sales declines. So this suggests that something more powerful than interest rates is driving buyer behavior. So there's the wild card, trade tensions. They're creating a perfect storm of uncertainty, job security concerns, that potential unemployment increase, higher costs of living. We're estimating like $2,000 annually per household. Supply chain disruptions affecting housing materials, constant policy shifts making long-term planning difficult. These are all factors that directly impact buyer confidence, regardless of rate savings. And of course, not all markets are created equal. The tariff impact won't be uniform across Canada, for example. So we're going to see how that plays out differently in local markets. So while lower rates create opportunity, sentiment will likely prevail in the short term. Continued buyer hesitation will carry on until some of those uncertainties are resolved. Price stability rather than growth in most markets is going to be a big concern. And motivated sellers offering greater flexibility. We are definitely seeing that play out in the market. So this means there's opportunity for buyers with secure employment. The market's not going to be defined by rates alone, but by how a buyer feels about their financial future. So again, many are waiting on the sidelines to see how things play out. And what it's doing is it's keeping home prices low, even while the rates are low, and providing a really solid opportunity to buy. So if you're a first-time home buyer, this could be the right time to get into the market. Yes, Tanya?
Yeah, and I think it's really important to note that currently, now we're sitting November 2025, and for the last couple of weeks, there have been more price corrections and there have new inventory. And previously, there were for 16, 18 weeks prior to that, there were almost as many price corrections each week as new listings. And, so we're talking in Calgary alone, 800 to 1,000 price corrections every single week across all the market sectors.
Yeah.
And now, I just looked at the ticker yesterday. We had, a little over 600 new listings, but over 800 price corrections. So, some really, really, really big opportunities for buyers right now, for sure.
Yeah, couldn't agree more. All right. So that's it for me today. Love how interactive that was. Cause this is, this is such a big part of your business too, Kelly and Tanya. You're out there on the ground with these, you know, prospective first-time buyers. And you're seeing the comps and you're seeing how homes are selling in the market right now. So you guys know better than anyone what things look like for these buyers. And yeah, it's a good time if it makes sense for you. I always say, like, the best time to buy is when you're ready. Don't worry about what's going on in the market. Don't worry about, you know, try not to worry about what interest rates are. I always say, marry the house, date the rate, because the rate is going to change. We're going to have a minimum 5 interest rates throughout the life of our mortgage, if not many, many more, right? So that interest rate is not going to be, we're not the United States. We're not going to have the same interest rate for 30 years. It's going to change, and we're more vulnerable to those shifting market conditions because of that, because we generally don't take mortgage terms for longer than 5 years. I mean, they are longer terms that exist, but I don't always recommend them. But you know, if you take out a standard 25-year amortized mortgage, then you're going to have a minimum of 5 terms and minimum 5 different interest rates. Unless you choose variable, you could have lots and lots of interest rates depending on what the prime rate is. But yeah, so it's, you know,
lots of interest rates.
Yes. So, you know, a lot of my first time buyers, I'm going to stop sharing that. A lot of my first time buyers last year or in the last year, you know, they bought their home and they ended up in a rate that was maybe closer to 5% or even higher than 5%. It wasn't the best market time to buy, but it was a time that made the most sense for them to buy. But it means that at their next term, or even earlier, if it makes sense, they're going to renew into a mortgage rate that's a lot lower than it was when they first bought. So it's not like they're the only ones who are dealing with higher interest rates. Everybody who has a mortgage is going to have mortgage renewals that go up or down. And we just have to ride that wave together.
Just like those of us who got in on those super low rates about 5 years ago, and we're looking at renewing.
They're all renewing into higher rates now. We're talking about payment shock with those people, how to reduce it, how to mitigate it. Maybe extending amortizations back up to 30 years to reduce their payments because their interest rates are going to be more than double.
Yeah. I also love today. It was like more like a podcast or something.
I know. Maybe that's what we need to do next, is just start a podcast.
Right. But also just one final note, especially for buyers, first-time buyers, is like, be honest with your mortgage broker and your realtor about what your intentions are. We are here to give you the best advice for your situation. And if, you know, like if you want to flip an apartment versus live in it, we might have different advice for you. And Jen might have a different mortgage product for you.
Yes.
And so it's really important that in terms of like your intentions and your goals, that you're honest with the professionals that you're working with, so that they can guide you. Like, it might not be it's a great market for somebody who wants to go and live in a home, especially in certain market sectors, but like every market sector is performing differently, and the market's better for certain types of buyers than for others. And so if you're not going to be honest with your intentions, then the professionals in your field can't really guide you appropriately to make the best decision and give you the information that you need to make the best decision. And so like one final food for thought, I guess, in terms of anybody that makes it this far in this webinar.
Awesome.
Yeah, I love it. Thank you.
Thanks for jumping on with us again, and thanks for all the information you've been providing.
Yeah, it's been fun. I've
We're
enjoyed
a wealth of knowledge.
I hope so,
Jen.
Yeah, well, yeah, always happy to do this whenever the opportunity comes up. If you guys ever want to do more, I've got lots of other topics we can cover.
I love it. I'm in.
Thanks.
Well, okay. Well, bye, ladies. We'll shut her down. And if anybody has questions following up, they can follow up directly with Jen, or they can send an email, urbanhavengroup@gmail.com. And we will either direct you directly to Jen or answer your question, whoever it's relevant for. We'd love to hear from you. Have a great day.